Greetings, my beloved clients and friends. I want to do a video today because, as many of you may have noticed, we're facing a challenging market environment right now. We talked about it in our November, December, and our start of the year videos, but I want to go a little bit more detailed because it's something that we should keep an eye on. So, what's going on? Well, interest rates have the Fed has announced that they're going to start raising interest rates, and they said that probably this year they'll have 3 interest rate hikes and perhaps another 3 in 2023. And so they changed their posture around November from very accommodative monetary policy to now starting to pull back, and because of inflation. That was one of the clouds on the horizon we talked about at the start of November, and that's really started to materialize. And so to combat inflation, the Fed's going to start taking money out of the economy. And that's really what, to a large extent, drove the phenomenal performance of the markets in 2020 and 2021 was when coronavirus hit and shut down the economy. Governments and central banks around the world started flooding the economy with liquidity so that the economy wouldn't shut down. And obviously that liquidity went to ended up in assets, in real estate, and in the capital markets, and it drove asset prices way up, which we saw coming, and we took advantage of that, and so it really benefited the portfolio over the last 2 years. And so here's why we shifted into growth when liquidity became so abundant. What happened was interest rates went down to zero, and so the interest rate is the cost of money. So if the cost of money was zero, it makes sense to allocate to an investment that's going to get more than zero, to not sit in zero and move it into something that's going to get more than zero. And when the opportunity cost is zero, why not go after the type of investment that's going to give you the most growth, right? Because there's really no opportunity cost. And even if that growth comes in not for another 5 or 10 years, but the potential for that growth is very high, with an opportunity cost zero, those are the investments that look the most compelling, right? The things that are way out in the future. This thing could be huge, like cryptocurrency and the latest technologies and stuff like that, right? So those types of investments particularly benefit from a lower interest rate environment compared to, say, an established stodgy, if you will, investment like a utility, right? A utility is a monopoly. It's a sure thing. It's good for a solid 4 to 6%. You know what I mean? But in an environment where interest rates are zero, why go for something like that when this other stuff has the potential to do 20, 30, 40, 50, 100%, right? And there's no opportunity cost for money. So those more established type investments tend to lag in those types of periods in favor of the most growthiest and future growth type of companies. And we saw, starting about March of last year, kind of a shift away from the most extreme growth type of companies. The ones that maybe have real high revenue growth but are burning cash to generate that revenue. They're not even profitable, and they don't expect to be profitable for several years, right? We started seeing market pulling back from those. And then in November, when Powell announced that inflation is no longer transitory, we started to see around the end of November the next tier of growth coming, not the so extreme, but the next tier of growth companies come down. And then in January, start of the year, we started to see the next tier of growth companies kind of be repriced. And I think that was probably because, investors had taken a lot of capital gains already, and they said, well, let's wait until next year to take the next round of capital gains. So that next tier started coming down. And it's possible that we see these companies that have really gotten overvalued because so much money was flowing into them. Yeah, their story is great, but the valuations had gotten out of whack. And that it takes several years for the optimism of the market to grind out of those companies. And in the meantime, money's going to go back to those established companies that, they don't have anything exciting happening 5 to 10 years from now, aside from just steadily making money year after year, because those ones were kind of neglected and in some cases even undervalued. Okay, and so why does that happen? Well, imagine if interest rates were 6% and the cost of money was 6%, right? So money wouldn't leave a secure guaranteed 6% unless it could do better. So there would be a hurdle to overcome on a presentation, and you got to say, well, you got to make me more than 6, or else I'm just going to leave it in this secure investment. And if the presentation is in 5 years this investment's going to really start to pay off, well, then you got to make more than 6 for 5 years, or 30%, and compounding is actually more than that, right? In order to get me to move out of this, if I'm not going to see any returns for 5 years, and I'm losing 6% every year in opportunity cost, you better have a really compelling story, right? So as interest rates go up, fewer and fewer of these high future growth companies meet the hurdle of a good investment, or they get priced down back to where it makes sense. So that's what's going on in the markets right now, and we're making changes because we did benefit from the easy money, and we went into the companies that would benefit, many of the companies that would benefit most from that, and it worked well in our portfolio. But it's time to do some harvesting, right? It's like if we had grapes on the vine, there's a time to go ahead and cut them at their sweetest, right? And if you don't, it's going to get too sweet, and it's going to start rotting, and it's going to shrivel up and just fall to the ground, right? So we don't want to do that. We're going to have to do some harvesting. Okay, so we've been harvesting since November, and we've been accelerating that and moving from those higher growth companies into the more traditional companies that have value today, and that are making money today. Okay, so we bought companies like AT&T and Berkshire Hathaway and Steel Dynamics and Regeneron. We're looking at Amgen, Dow components like that, and away from, so we're selling some of our big winners, and you're like, why are you selling that? That's a great company. Yeah, but it's overvalued, right? The time to harvest has come. Okay, and actually, we left some on the vine a little too long, but it's going to keep rotting more if we don't. There's a chance of that. So we have to change with the seasons. And to toot my horn a little bit, not all firms would have that approach. And I'll give you a couple examples. When I started in early in my career, I started at Wells Fargo. They were a big, they still are a huge financial services company, big investment manager. And in the 90s, they were doing a lot of things really good. And that's when I was with them, and they had a really sharp manager at the top, and he was doing a lot of forward-looking things. But he had a mantra for investment management was be long or be wrong, right? Basically be long equities or be wrong. And in the 90s, equities were the place to be, so we were long and we were doing great. But similar to today, valuations started to look really stretched around the end of the 90s, and they continued with their mantra, be long or be wrong. And then year 2000 came, and the Y2K thing didn't materialize, and we've talked about how that really affected the dot-com and the growthiest of companies, similar to today. And they continued with that mantra, be long or be wrong. And I remember one of the senior VPs we're at a meeting with this guy from Putnam, and they were we were talking about investing strategy, and we're like, so what do you think? And he said, well, it might be time to look at value. And he almost got laughed out of the room. And in hindsight, he was right. And because Wells Fargo was like, well, be long or be wrong, they didn't really heed that warning, if you will. And it was frustrating working there, because I was hiring investment managers. I was not managing individual equities at that time. And Wells Fargo wanted me to be long or be wrong, and I was like, there's kind of signs here that it might be time for a change. And why do we have to be long or be wrong? How about this mantra, be right? But no, they were stuck on be long or be wrong. So early in 2002, I left there because I was tired of being wrong. But what I learned was that big companies like that have a large platform that manage tens or hundreds of billions of dollars of assets, they kind of have to be long or be wrong. Because if a company that size all of a sudden came out with their New Year outlook and they said we're out, they'd move the market, right? And they'd cause a run. They're too big. They can't say that kind of thing, even if inside they know it, So I would say that being with the firm, like our firm, we manage just under 100 million in assets, and 50 people are going to watch my video. So if I say, hey, we're shifting, I could do it, and I'm not going to move the market, right? I have an advantage, if you will, over those huge firms that are kind of painted into a box almost. That they almost have to, because that's their business is selling securities, so they can't say, hey, time for you to not buy our securities anymore. And I see it when I'm watching the financial networks, even like Kramer, anybody with a big audience, they know they can't say time to get out, right? They can't say it because they have too big of an audience, and those kinds of things will really negatively impact the markets. So I think you're at an advantage being with a firm our size, that we're able to move when it's time to move, and we're not handicapped by our size. And so a second example I want to give you was around that same time, around 2000, I'd been working with this company called TCW, using them as a growth manager, and they were a great manager. They had a tremendous track record throughout the 90s, and they were beating the market. And they're returns were like north of 25% annualized. And so a couple times a year, I would take a group of clients to do a due diligence meeting at their headquarters. They're on Figueroa between, I think it's 7th and 8th, right there by Staples Center. If you ever are in that area around Staples Center, look up one of the big buildings on top. It's going to say TCW, and that's their building. That was their headquarters. And we'd go there a couple of times a year, and we'd take a handful of clients, and I think they occupied the 16th and 17th floor there. And you walk in, you go up the elevator, and the elevator's doors open, and it's their office, because you don't have to go through a doored office because they have the whole floor, and it just smells like money. It's beautiful mahogany, and I actually, the lady that designed it was my client, but I mean, it was a beautiful office, and the receptionist behind that big mahogany desk looked like she was probably a former supermodel, and they show us into the conference room, and it's this massive boardroom with a view of the downtown skyline, and this huge state-of-the-art big solid wood oval desk, and big leather captain's chairs, and then their senior VP comes in, and he's just very polished and articulate, and just Ivy League type of guy, and gives an amazing impressive presentation about the company and their strategy and their history and their track record, and then at some point in the presentation he points to one of my clients, and he says, and by the way, sir, you're sitting in Mr. Kissinger's seat, because Henry Kissinger is on the board of directors of this company. And so it's just extremely impressive. And then we'd take a break for lunch, and we go down to their cafeteria. And by cafeteria, I don't mean a fiberglass tray and you walk the line and they scoop stuff on your plate. I mean white linen tables, white linen tablecloths, and waiter, and the place settings is bone china, and they serve you the iced tea in these crystal glasses, and sterling silverware, and just nice, again, a view of the skyline, and the chef comes out and he brings out the first course. It's a salad and this big old plate, two little pieces of lettuce, but it's not iceberg lettuce. It's like the lettuce of the kings, and it's the most delicious salad I've ever had, and just impressive. And then after lunch, we go to down the next floor where the traders are, and we go into the trading room, and it looks like Axe Capital. If any of you guys watch Billions, it just looks state of the art, and the guys look like they're making money for you. Around the corners and the corner offices are the portfolio managers, and we meet the manager for the growth fund that we're invested in. The guy's just sharp, and pictures of presidents himself with presidents on his wall and stuff. And so obviously people wrote checks. We'd go to that thing, and people were impressed, and it was a great company, and we raised a lot of capital on those due diligence meetings, and I did them a couple times a year. And 2000 rolled around, and I called my guy there at TCW and said, hey, I want to bring another group of clients over to do a due diligence, and I didn't get a call back. He ghosted me. I left several messages, and I couldn't get a hold of the guy, and I started getting a little irritated, and what's up? We've done plenty of business together. We've had a good relationship for many years. Why am I not getting a call back? Finally, someone from, not even him, someone from the office calls and say, hey, so-and-so, your guy, he's kind of busy right now, and he can't really do a due diligence meeting with you, but here's a couple names of a couple other firms that you might want to call, and not someone else in TCW, other firms, competitors of his, that he's like, go have the meeting with them. I was like, what? I felt miffed, because we had, like I said, we had done a lot of business together. I thought we had a good relationship. Well, and I did some investigating. I figured out what was going on. It turns out that TCW was a large cap growth manager, and they were buying these and having great success with these large cap growth companies. And they knew that the valuations had got extremely stretched, and they knew that the prospect for them to be able to continue to get the returns they had gotten very slim, and they didn't want to bring in any more money because they knew they couldn't deliver the same kind of returns. That the likelihood of that was very low, and so they didn't want my money. They didn't want me to come over, and in a way they were protecting me and my clients and say, no, don't bring any more money because it might not do so good. And they were right, but they could not, even though they knew their strategy was going to be out of favor, they could not switch to another strategy, because here's how the industry works. Portfolio managers like me would hire these companies for a specific task, right? You need to manage large cap growth, domestic, for me, and I'm going to hire you and to fill that box, but I'm going to hire other managers to fill other boxes because I want to be diversified. I want to have value and international and bonds, and so you need to stay in your box for me to effectively manage the portfolio. And they knew that, so they couldn't leave. Even if they knew that their box wasn't going to do well, they had to stay in it, right? Otherwise, they would be branded a style drifter by the industry, and that they would be a pariah. You can't do it. You can't style drift, even when you know your style is out. So that's the way of the industry. And I want to say that my company is style agnostic. We can go from this one style to another because we're not beholden to anybody else. We have not been assigned to a style box by the industry, so we're able to be more nimble. And if we see that the time for growth has come and gone, and the time for value is coming, or cash or bonds or real estate, right? We can move into different markets to protect and grow your wealth. So I just want to share that with you, that why I think it's I like being in the space I am, because I'm not boxed in by my size or by my style. But full disclosure, I gotta tell you the good and the bad. I manage money, taxable money and tax deferred. I mean, IRA and non-IRA money. And taxable accounts, when we do harvest, if we sell something for a gain, it's a taxable event, right? And that weighs on me a little bit because, like last year we had some huge gains that we realized, and it was a huge taxable event for some clients, and so I'm in a little bit of a dilemma. What I do, I'm looking at, if you will, the grapes on the vine, and it's time to harvest them. But if I do, it's going to be a taxable event. Do I wait and risk the grapes getting overripe and starting to rot, or do I just cut them off and now at the right time and realize this gain for my taxable client? So that weighs on me sometimes. I try to not let the tax tail wag the dog, but it is a consideration, and most of the times that I consider it influences my decisions negatively. So I really have to. But what I want to say is, if I'm doing a good job, and you're in a taxable account, you're going to pay tax because I'm making you money. And would you prefer me to not make you money and you not to have to pay tax? Right, that's just the nature that we're in. And you know, we've had great returns, and there's going to be some taxes to pay. And I guess in a taxable account, there's no way around that. The only way around that is to not make money. And I mean, you pay me to grow your wealth. And so I just want to give you perspective on where the markets are, what we're doing, and the fact that we're able to do this, and also the consequences. So we'll keep you in touch, because I don't think this challenging market is done with just yet. And so we'll definitely stay in communication and walk you through this. And we're definitely have our hands firmly on the wheel, and trying to navigate through this challenging time. So hope you guys have a great week and a great weekend.